Good afternoon, everybody. Today, our podcast is going to deal with the 3 mistakes that you don't want to make ahead of your retirement. Those 3 mistakes are big tax mistakes. And let's kind of take them individually if we can, because when you get into retirement, you don't want to make these mistakes. They can really hurt you. First of all, we've been schooled, we've been lectured to, we've been taught that all the money that you put away while you're working, growing in a 401k account, growing in an IRA account, once you retire, you're going to be in a lower tax bracket. And because you're in a lower tax bracket, when you take those withdrawals, then you're going to be just fine. You may not even owe tax on it. Well, the problem with that lower tax bracket is going to be, first of all, maybe not. The government, we have a bit of a problem in this country. President Trump, whether you love him or hate him, he lowered taxes about 1.5 years ago. It was an 8-year tax break, if you would, where we have lower taxes. Once that is up in about 6.5 years, do you think taxes are going to stay low, or do you think they're going to go up? I personally think they're going to go up. Why? We have a deficit in this country, which, depending upon whose numbers you listen to, are between 18 trillion with a T to $22 trillion, and that number is rising every day. That's a lot of money. And who is going to pay for that deficit? It's going to be the taxpayers. And because the largest single group of people who have the wealth in this country are the retirees that have the wealth in their retirement accounts, whether it be their IRAs, their 401ks, their 403bs. As you take that money out of the account, you have to pay taxes on it. And if tax rates are higher when you retire and when you start taking withdrawals from those accounts, you're going to pay more. The hope is that your account has grown exponentially as you put money into it, so the value of that account is growing as well too. And when you take those withdrawals, it will put you in a higher tax bracket perhaps. Not a good thing, not a bad thing, but it's a fact of life. And so how does the government fund its deficit? By increasing taxes. Who do they hit the hardest? Unfortunately, the people who are retirees, because that's where the money is. The second one is that once you take out those RMDs and it puts you in a higher tax bracket, it's going to affect your Social Security payment. And I want to read this because I want to make sure I got it right. The IRS keeps track of something called provisional income. What is provisional income? I didn't know about it until I read this article, but don't worry, most CPAs don't know about it either. But it's tax that the IRS will look at all of the sources of income, including your RMDs. And once you take those distributions out of your retirement account, that will add up your provisional income. And the provisional income is used to determine what tax, if any, you pay on Social Security, plus it will affect your Medicare benefits as well too. And so let's say if you're a single person, you can have provisional income up to $34,000. A married couple, $44,000. Once you go over that, you might find that 85% of your Social Security payments are taxed. That's not exactly the situation that you want. So, what is the solution for it? Well, a lot of people say convert to a Roth because you pay the taxes up front. Taxes are on sale right now, and it's a good time to do that. We agree. But we have a better plan than that Roth. It's called a LIRP, Life Insurance Retirement Plan. And it's like a Roth, and we've talked about it before on some of our podcasts, only it's better. It's like a Roth that's been supercharged. And we'd love to talk to you about it because we do it over a 5-year period, mitigate the taxes, and then you don't have provisional income. You never have tax on it. You get some great tax-free benefits. You have life insurance. You have long-term care, all tax-free, and a tax-free income. So we'd love the opportunity to talk to you about a LIRP, which will solve those 2 problems and enable you not to make any tax mistakes when you get into retirement. Thank you very much.